Not too long ago, all banking that you could think of, just about every banking service on the planet really took place within a banking hall. You had to waste a significant amount of time just queuing, and of course it was not exactly the most convenient thing in the world. But in the last decade, there's been a massive change with the adoption of mobile phones and a bunch of other technologies. Broadband access across Africa, for example, has become a key game changer for this. Banking now happens literally at the palm of your hand, but it's not all perfect. Let's see what the sector looks like now and what it looked like in the future. David Cracknell is the Global Technical Director at Microsave. He joins me now in studio. Thank you for your time.
Thank you.
So this market for digital lending, this is a bit I'm really curious about. We know what bank lending books look like. Same thing for savings and credit societies. But digital lending is the dark horse, as it were. How big is it?
Well, I think you have to look at digital lending in various different ways. So you've got at the bottom of the pyramid, if you like, the M-Shwari, as you know, the digital lending through M-Pesa. And you've got a number of different companies and products, Tala, Branch, and perhaps 20 different providers doing the same kind of thing. But these are really small loans, 1,000, 2,000, 3,000 shillings. But if you're really looking at digital lending more holistically, then you're thinking about how digital technologies can be added into existing lending processes, even of the commercial banks. And those changes are beginning to happen.
Right, there was something interesting that I saw in one of the blogs written by the Microsave managing director. This was in November last year. The basic thesis of that blog was that he was arguing that in its current form, fintech, quote, may be largely irrelevant, because which is it's an interesting contradiction, isn't it? Because we think of fintech as expanding access to financial services to a lot of people, but yet here we are saying, hang on, we might actually be excluding a whole bunch of people from fintech. Why is that?
Okay, I think if you think about fintech, what is actually being delivered through the mobile phone at the moment is often a very small loan, 1,000 shillings, 2,000 shillings, 3,000 shillings, that may be being used for household expenditure or something like that. It's not a game changer per se. It's not an enterprise loan. It's not necessarily going to help them generate more income. And this loan is fairly formulaic. Over a 1-month period, you're paying 7.5% as a fee. Now, really, we need to make the products and services closer to what people actually want to use and want to buy. Financial technology itself also has limitations. How do you collect a very small loan? At the moment, if you don't pay, you can be negatively listed. It's a bit like having a sledgehammer to crack a nut.
Instead of using a scalpel.
Yes. So the issue is, but you also have to think about the fact that many people need help and assistance. Your typical rural African may need to talk to somebody. They may not have a phone. They may not have a smartphone. They may need an app on the smartphone which helps them to interact with this technology. A sort of a slightly different approach where they're counting notes because that's what they do normally. So a more graphic approach to using one of these apps. Now,
so to understand you, just to clarify, that the current approach, as it were, because it's mostly USSD services, to use M-Shwari as an example, really isn't fit for purpose in expanding access, at least not to the level that we'd like.
I think that it is a step, and it's a step in the right direction, but for it to be considered as the end product, it's certainly not. It's a step. So, for example, if you've got a market trader that wants credit for a day, why are they using M-Shwari or a similar product to buy credit for a month and paying 7.5% for a month when in fact they want the money for a day to increase the sales for the day?
So there's a liability mismatch there. Alternative credit scoring, because this is something we've been debating in this country, especially given the fact that now we have a rate cap law that's been in place for the better part of about 15 months. But with all the information that digital lenders do develop, why aren't we seeing alternative credit scoring happening, and off the back of that, differential lending rates?
Well, I think that there's a lot of things that need to be in place, particularly in the banking sector, before alternative scoring can really work, because of the way that bank data is structured. It's not structured really for data analysis. you would need data warehouses, or you would need different types of systems in order to interrogate that data. And banks typically are not using the data that they have. So if you want to develop alternative scoring mechanisms, and mechanisms that can be used to provide risk-adjusted interest rates, then we're a bit far away from that, simply because of the way that data at bank level is structured.
But what about on the lending, on the digital lending side? Because I mean, that seems like this massive missed opportunity that someone like Branch or Tala or Resolution Credit would just jump right into head first.
Well, one of the challenges is that many of these micro or nano lenders, as you might call them, they have scorecards, if you like, and they've got algorithms, but the principal data point they use is, have you paid the last loan? So what they're doing is they're graduating people through a series of small loans.
Right, which doesn't tell us much. Which
doesn't tell us much, and it means it's going to take time for people to get the credit history on which you would give them bigger loans.
All right then, one last question for you. By the end of 2016, we had, 35 financial services, which had about 1 million plus active users. We often hear about the success stories, but we rarely ever do hear about the failures, the ones that didn't make it. What do we usually learn when we start digging into that dark hole that no one usually wants to poke into?
I actually think that obviously Safaricom's M-Pesa has been an international success story. But there is a challenge with an international success story because people fail to differentiate between what's a principle, i.e. this is how it works, and what's a practice, which is local. M-Pesa was designed for Kenya. Microsave was involved in the design of M-Pesa. It was piloted for 18 months. By the time it was launched, it was designed and fit for purpose for Kenya. Other people then just copied, cut and pasted. And yet, is Zambia the same as Kenya? Is Tanzania the same as Kenya? Is Uganda the same as Kenya? And you've got to remember the demographics of Kenya with split families mean that P2P, person-to-person payments, is a huge dynamic. If you go to Ethiopia, 85% of the families live together. So is a volume driver going to be a person-to-person payment? Not in the same way. You have to find a different economic rationale that's driving the service. And obviously, Safaricom, when M-Pesa was launched, it was in a battle for subscriptions, for airtime. So the real driver for M-Pesa at the beginning was actually to create customer loyalty. Now, the business case for mobile money has shifted to, does it make money for us? And so Safaricom could put a large amount of money through into advertising and promotion to protect its core market share. So this became an attractive value-added service. It was then later, when it got to volume, that it really started showing its potential.
Fascinating stuff. As ever, an eloquent reminder, Africa's not a country. You can't afford to have that copy and paste business across the board. Thank you very much, David Cracknell.
Thank you.
From Microsave, the Global Technical Director there with us in studio.